Welcome to Money Control. It's a rather cheerful morning, it looks like, with the market hitting a fresh all-time high today. Yesterday was a bit of an anti-climax in the US market as the market rallied on softer than expected inflation data. But the Fed commentary turned out to be super hawkish. The dot plot showed one rate cut compared to 3 rate cuts as projected in March. But the US market, the good thing is that the US market did not give up all the early gains that it made yesterday. So people are taking away a cue from there that the Fed may not have fully accounted for the softer than expected inflation data that came in yesterday. To talk about this and a lot more and the prognosis for emerging markets and India, we have a market expert, Jonathan Garner, Chief Equity Strategist for Asia and Emerging Markets at Morgan Stanley. Thank you so much, Jonathan, for joining this morning.
Good morning.
First of all, are you surprised by the Fed commentary yesterday? What is your house view? What is Morgan Stanley's house view on how many rate cuts this year are we seeing?
We think there'll be one Fed cut in September, but I think I'd really want to start by emphasizing that the Federal Reserve is really not that important for the performance of equity markets, particularly a market like India that's in the middle of a very strong secular bull market driven by strong domestic earnings.
Sure. So is this noise that we can ignore?
Yes, in fact, I'd rather look at it differently from the way that most people do. I think you were mentioning in your introduction a sort of a hawkish Fed. The whole reason that the Fed is on the sidelines is the US economy is performing fine. We've got like disinflationary environment, but very strong underlying real economic growth. And in particular, a very significant CapEx story that's appearing in AI related, which is very good for productivity. And so a Fed on the sidelines just lets normal economic activity carry on, and the corporate earnings environment in the US is also very strong in terms of earnings growth. In fact, across most of the world, we have this pattern of strong disinflationary growth, same here in India. It's only really China that's struggling economically at the moment.
So right now, the US is at US markets are at an all-time high. So are a lot of other world markets, including India. You think an encore in terms of stock market performance is possible in the coming year?
Sorry, an encore stock market performance?
Yeah, I mean,
what was your question?
Yeah, do global equities as a whole, do we see new highs going into this year across global markets?
Yes, well, we are bullish on global equities. We're overweight global equities, and we're particularly bullish in this region on Japan and India, both of which have made new all-time highs this year. And India obviously doing very well since the election. India is our largest overweight in emerging markets. But not everywhere are we bullish. We're not bullish on China. We think that rally fades. And we've downgraded some other markets in our coverage earlier this week, including Mexico and Indonesia.
Sure. So before elections, Jonathan, there was this huge, buy China, sell India kind of trade that was playing out. And some of the investors we were speaking to were saying that this is because the Chinese market had really bottomed out and the valuations were very cheap compared to historic valuations that you've seen. Has that completely played its course or is that trade still on?
Yes, we disagree with that.
From the time it started rebounding, about 20-30% growth has already happened.
Yes, we disagree with that view. In fact, we think that India is heading for a fourth year of outperformance of China. It outperformed in 2021, 22, 23. We think it'll outperform again in 2024. And the reason is the underlying earnings growth environment here in India is at least 15% dollar EPS growth, whereas actually for 10 years now, there's been no underlying earnings per share growth in China. So you can get these short covering low quality bounces in a market that's becoming inherently more volatile, i.e. the China market, But the structural secular bull market is right here in India.
Sure. And in terms of, valuation differential, I saw that in terms of consensus estimates, emerging markets right now is about 12.5 times. The Chinese market is about 10.5 times, and India seems to be on the higher side. Not that it has not been on the higher side earlier. India has always been an expensive market, but in terms of differential, do you think this will still be alluring for people who are looking at India fresh?
Yeah, it's true that India to some extent is on a growth multiple, but that's very much deserved by the earnings growth that I've been emphasizing throughout this interview. If you look at Indian earnings growth versus overall emerging markets, it's 60 percentage points higher in the last 3 years. It's quite simply compounding earnings much faster than anywhere else, whereas China's not compounding earnings at all. And so the China valuations essentially represent a value trap. It's not a great idea in equities to buy just simply on a low 1 year forward PE or price to book if you're not thinking about the earning streams in the future that you're buying and the ROE that you're buying. And if you look at India's ROE, it's one of the highest in global markets. In fact, only really the United States has higher return on equity than India does, whereas China's return on equity has approximately halved in the last decade.
Sure. Jonathan, one of the other arguments that I've heard a lot of people talk about is that, the single country specific funds are not that huge, and most of the money that comes into India also comes through allocations to emerging markets as a whole, of which China is a big part. And if the Chinese story doesn't look better, then the possibility of allocations to overall emerging markets will not be healthy, and that will be bad news for India as well. Do you subscribe to this narrative?
No, I don't. For the simple reason that there's now a big surge in issuance of funds that are what you might call EM ex-China funds or Asia ex-China funds. So you can buy products that don't have China in it. And whilst it's true that single country ETFs, let's say for India or say Taiwan or Korea, they're quite small versus say single country ETFs for the US or Japan, what I think is the next phase in the India's market development is that truly global investors buy India for the first time. Remember that in the all-country world index, the global equity superset that's around $50 trillion, India is now around 2% of that benchmark. It's basically more than tripled in recent years. And that means that whereas it was within tracking error before to sort of ignore India and other smaller markets, it's now reached the point where global investors have to start buying.
Jonathan, do you have an estimate? Can you share some numbers to put some color and perspective on this? What kind of money you think may be waiting to enter India at this point in time? The kind that you talk about.
Well, global, it depends how you count it between active and passive mandates, but they're in the trillions of dollars globally. Obviously, you've got several individual stocks in the United States that have market caps in the trillions of dollars. So this is completely different from the way that people maybe have thought about it historically here in India, where I'm often asked about FII flows, and effectively you're asking then just about what are emerging market funds doing. But that world has rather finished now because, as I said, you've separated China out from overall EM, and because the scale of the Indian market is now reached a scale that you're going to get truly global investors coming in to look at some of the big stocks here. So, take a name like ICICI Bank that's in our focus list. It's that kind of stock that global investors are likely to buy when they look at this market and buy their first stock.
All right. And one more question on this emerging markets theme. Again, one of the things that I pick up from other investors is that, there is this conversation about Korea moving out of the emerging market index into the developed market index, and that could create more headroom for India's weight to go up. Do you think this is a possibility in the coming year?
No, we don't. We think Korea will remain in the EM index for the foreseeable future. And I wouldn't say that that is a barrier to India's gaining share. The outperformance of the market is so profound that actually India is already the second largest market in the overall EM index. And it's quite likely in the next 3 years on the traditional EM index that it will supplant China and be the largest market outright.
Sure. And coming back to India, which is what you started out saying, that this is a secular bull market, where do you see pockets of growth? I mean, your India team, and where do you see pockets of weakness?
Well, what we like particularly as domestic demand plays, so consumer discretionary, industrials, financials, and real estate, which is a sector that we didn't really used to recommend exposure to in India, but is now actually reaching sort of liftoff, as it were. And we're more cautious on externally earning sectors like IT services, outsourcing names, pharma names, and obviously on defensives. We're not in a defensive posture on India.
Sure. Also, Jonathan, the kind of investors you talked about, and you said that, those are the investors who will look at big bets like ICICI. So you're saying largely these are going to be unconnected to the index, although, of course, ICICI Bank is an index stock. But could it also flow into the mid-cap, small-cap segment, or will they be large bets in the key sectors led by financials?
I think that's very unlikely. The theme that I was expressing to you there is that now that India is a much larger market, you have the truly global funds who can invest anywhere in the world. In the heyday of China, they would typically maybe have 2 or 3 China e-commerce internet names in their portfolios, and that's now changed largely. They've now largely departed those names. So what you'll find is 1, 2, or 3 mega cap India stocks finding their way into global funds. That process has already started, but it will accelerate.
Yeah. So one thing that one is also perplexed about is why is it that, what is it that is changing now that will accelerate this change? Because if one thing that has been clear to the market, at least in the last 1 year, that all these banks have been relatively, if you compare the rest of the market, are more moderately priced, or, if you could call it undervalued. Yet, large private sector banks have been the laggards.
Well, you're asking that question sort of looking at the way that domestic investors would look at the market, and obviously we're aware that there's a retail-driven small and medium stock boom going on in India now. There's also a boom in options trading going on. But that's characteristic of an overall situation where you've got a young, dynamic population engaged in sort of wealth creation. But the point I was trying to make earlier in terms of the way that global investors look at this, they need to have liquidity to enter a market, and it needs to be meaningful versus their benchmark index. So when India was only, say, 50 basis points, it's within their tracking error, they can afford to ignore it, but they can't afford to ignore it now that it's the second largest market in EM and on track to be the largest market.
Fair enough. And so are you bullish on HDFC Bank, Kotak Bank, some of these private sector banks?
I can only comment on the names that we're currently recommending. So other than ICICI Bank, we also recommend Maruti Suzuki, Gale, and Godrej in real estate. Okay.
One of the things that the market has recognized in the last 1 week after elections is there is a distinct shift in terms of sentiment towards consumer and IT stocks as opposed to the infrastructure, capital goods, economy sensitive stocks. Do you think this trend could accelerate?
Yeah, it's interesting at our conference here, obviously there's been a very big CapEx cycle in recent years, and so that sort of the CapEx theme, infrastructure theme has been very strong. But I do think now the elections are behind us, we can move to maybe more towards the consumer side of things. And again, that's a very rich environment. There's a very large number of stocks there to play.
Sure. That's all from me. Thank you so much for joining me this morning, Jonathan. Thank you.
Thanks very much for having me. Thank you.